Good afternoon and welcome to Capital Account. I'm Lauren Lister here in Washington, D.C. These are your headlines for Tuesday, July 3rd, 2012. U.S. manufacturing activity contracts for the first time in 3 years. The weak ISM data came as a shock to economists reportedly, but then it came out orders placed with U.S. factories rose in May for the first time in 3 months, according to other data. We'll talk about where figures show global economic confidence, crises and slowdowns are really headed. Also, BlackRock's vice chairman Byron Wien, according to him, he spoke to the smartest man in Europe, and what he had to say was terrifying. Basically, that massive amounts of debt will bring the decline of Western civilization, but that in the meantime, before that happens, policymakers would pull every trick they could in order to stave off a catastrophic event. Why do you have to have the unnamed smartest man in Europe, as christened by a Blackstone bigwig, say that for that to hold weight? Just watch a lot of smart men and women who break this down openly any given day, right here on Capital Account. Today, commodities guru Jim Rogers will do the honors. And it is 1, 2, 3 strikes. You're all out as Barclays' top 3 executives resign in the wake of the LIBOR manipulation scandal. Chairman, CEO, COO. Now, we ask, why haven't we seen this kind of fallout at big banks based in the U.S. for many settlements and scandals they've come across? We'll muse over it as, what do you know, JP Morgan finds itself under investigation for manipulation of electricity markets. Let's get to today's Capital Account. So stocks rallied today in the U.S. and Europe, and if you believe the headlines, it's because American factory order numbers came out beating expectations, thus easing concerns that manufacturing is faltering. There was another report that came out before that showing that it was. Now, also, there's speculation central banks will act. Or, I don't know, maybe the potion from the EU summit's short-term solutions last week hasn't worn off. Regardless, headlines aside, stock market action today aside, what does any of this potentially market-moving data mean in context about where countries, currencies, the global economy is headed? Well, look at this out today in the German paper Der Spiegel, the English language version. Take a look at this headline: Euro endangers the German economy. The common currency union was supposed to benefit the economy of the entire European Union. Now that the euro is struggling, however, it's bringing growth down with it. Germany's economy, once seemingly immune to the crisis, is now facing mounting difficulties. Uh-oh. Germany turns against the euro project, then what? I don't know, maybe bankruptcies? But is that just what economies and banks need under the weight of too much debt that they're saddled with? Well, Jim Rogers, investor and author of this book, A Gift to My Children, A Father's Lessons for Life and Investing, gave me a few lessons in both. Last night, I asked if the measures that came out of the EU summits, including the rescue funds, ability to bail out banks directly in some cases, which will apply to Spain, for example, are short-term band-aids or bad precedent altogether. You know, he said every time something comes out of one of these summits, there's something new that sounds wonderful for days or maybe even weeks until people figure out this is nothing different. It's just propping up failure. Take a listen.
This is the same old, injection of funds into somebody's artery, into somebody's vein, hoping it'll keep the situation together until after another election.
In lieu of continuing this kind of life support, and who knows when the patient is going to die, I know you've talked about bankruptcies and said that it's bailouts, actually, that could lead to even some kind of a war scenario. What is that scenario you could see playing out?
Well, Ms. Sister, throughout history, when you've had economic times that go bad and then get worse, people get angry. They look for somebody to blame. And they always blame foreigners, they blame other countries, they blame bankers. I mean, this has always eventually led to strife. Let's hope it doesn't this time, but throughout history it has.
What scenario would you see playing out that led to that? What does Europe really need to avoid at this point?
Well, it doesn't have to be war in Europe. It's a big world, you know. It could be civil war in Europe. We've already had the inklings of some strife. You see what's happened in Greece. I mean, you see people in the streets in the UK and other countries. So it could be civil strife and civil unrest as well. Or it could be, you know, they could blame the Asians. Everybody loves to blame somebody far away. I don't know who they'll blame the next time around. But, Ms. Lister, throughout history, since the beginning of time, we've had wars. I would love for us to stop wars because they're a total waste of time, money, and everything else. Energy, human life, they're disasters. But unfortunately, we've never learned our lessons.
I'm with you on that. It definitely would be a disaster scenario. In terms of the disaster that appears to be the euro right now, what would it take to stabilize it, and over what time period will it take?
Well, the only way it's going to stabilize is for there to be sound economies and sound economics throughout the countries that are part of the euro. And with it, my solution would be to let people go bankrupt like Greece, the bondholders take losses, the banks take losses, and then start over. Another scenario, which is not as good as far as I'm concerned, would be to throw the Greeks out or let the Greeks go. And so that and whoever else has to go that's not going to base their economy on sound principles. Then you start over with a new euro based with just sound countries. I don't think the euro could survive that kind of scenario, but that too would be another way that it would work. But the way it's going now, Ms. Lister, it's not going to work. You keep having a Band-Aid every 4 or 5 months. That's not going to work. That's going to end in disaster someday.
And if there is bankruptcy allowed, if there are, say, mass bankruptcies and the government got out of the way, stopped trying to put on Band-Aids, would the free market be enough to solve this, or does it require any mix?
What you just described is capitalism. Wouldn't it be wonderful if we could?
It sure would be novel. We haven't seen it in a while.
It certainly would be novel, that's for sure. I mean, the Chinese have more capitalism than we do. Would it solve? It would be terribly painful, Ms. Lister, I assure you. It would not be fun. But what we're doing now is going to be more painful in the end if you have wait another year or 2 or 3, and then at some point the market is going to say, we're not going to give you any more money. We're not going to lend you any more money. We find this absurd. And at that point, the whole situation collapses. There's nobody who can save us. The Germans don't have enough money, the Chinese, the Europeans, the Americans, nobody. At that point, we have catastrophe, and that's when you start having real civil and perhaps worse unrest.
Because at that point, the debt's even bigger because it's just been passed around to some kind of more central authority or bigger player. Now, the weak demand that we're seeing as a result of what's going on in Europe, the weaker demand from North America, has contributed to weakness in China's factory activity. Reportedly, it shrank in June the fastest pace in 7 months. Now, these signs of slowdown globally are what some are attributing a slump in commodity prices or a drop in them to right now. Your index says commodities are down just over 12% last quarter. Are you concerned that in the short term commodities are going to continue falling?
Well, you're exactly right that economies around the world are slowing down. The Chinese have been purposely for 3 years trying to slow their economy, rightfully so, in my view. I mean, they raised interest rates several times. They raised reserve requirements a dozen times. They've been trying to slow their economy down to pop the real estate bubble and to get rid of inflation. So I don't see why anybody's surprised that the world economy is slowing down. Europe is in chaos, economic chaos. America's got staggering debts. So of course the world economy is slowing down. And anybody who sells anything is feeling the effect, including the people who produce commodities. Some commodities are certainly down. I mean, agriculture is not down this year, but other things, metals and energy, is certainly down this year.
And looking over the past 10 years at a broader trend, commodities in U.S. stocks have diverged significantly only twice, and both times for about 9 months. Our viewers are looking at a chart of that right there. So we're currently seeing another divergence right now, with commodities declining this time and stocks rising. Do you think this current divergence is sustainable?
No, I suspect what will happen is that as the economy slows, you will see governments and central banks around the world printing more money and then that money usually goes into real assets. That's where it goes first. By the way, I didn't see your chart, but I will say to you that commodities have done 700% better than stocks over the past 12, 13 years. So maybe there's something wrong with your chart. I'm sure there are periods when they have done whatever you said, but commodities have done much, much better over the past 13 years than stocks.
How long do you think it could continue with stocks and commodities diverging?
Normally, stocks and commodities do diverge. I mean, that's the way things normally work. You, over the long period in secular markets, you have commodities going one way, say doing badly, and when stocks are doing well, and vice versa. If you have the big picture over a decade or two, they usually go separate ways.
Okay. And
have in the past.
Okay, and we've seen a steady increase in the price of gold over the last 10 years. You and I have talked a lot about it, and this trend has reversed since late last year. You said earlier this year, if gold dropped below $1,600, you'd be interested in buying more. So have you held to your word?
I bought a little bit. I mean, not enough to even acknowledge that I bought some, but yes, I have. Gold has been up 11 years in a row, and I've never seen any asset that I can remember that was up 11 years in a row without a downturn. So it's normal what's happening in gold. If gold continues to go down, I hope I'm smart enough to buy more. But I have no idea where, Ms. Lister. Yeah, I bought a little bit recently for a variety of reasons, but not enough to talk about.
Okay. I know that we don't have a crystal ball. You're certainly smart, but I don't know if you have psychic powers. Do you think now is the time to buy, or do you think that potential significant drops in gold, I know you've talked about a correction before, do you think we still haven't seen those yet?
Well, I don't need psychic powers. I watch RTTV. They know everything. But I'm not buying gold now. It would not surprise. You know, the Indians are talking about, the people in India talking about banning the sale of gold, or certainly making it very difficult for Indians to buy gold. The Indians are the largest consumers of gold in the world. If something like that happens, Ms. Lister, the price of gold could go down a lot. If that happens, I hope I'm smart enough to buy more.
And that's not all. Still ahead, we'll have more with investor and author Jim Rogers, his take on the Federal Reserve's claims about inflation. Plus, while we're on central banks, ECBers say they're overworked, and the Bank of England may have played a role in the LIBOR scandal. We'll talk about it in Loose Change. But first, your closing market numbers.
Drives the world.
The fear-mongering used by politicians.
Who makes decisions?
Considerable breakthrough has already been made.
Who can you trust?
No one who is imbued with a global missionary zeal.
Where are we heading?
State-controlled capitalism is called fascism.
When nobody dares to ask, we do. RT, question more.
You know how sometimes you see a story and it seems so whole and complete, you think you understand it, and then you glimpse something else. You hear or see some other part of it and realize everything you thought you knew, you don't know? I'm Tom Hartman. Welcome to The Big Picture.
Welcome to the Alona Show, where you'll get the real headlines with none of the mercy. The problem with the mainstream media today is that they're completely disconnected from the viewers and from what actually matters to those viewers. And so that's why young people just don't watch TV anymore. If they want news, they go online and read it. But we're trying to take those stories that people actually care about and transfer them back to TV.
Welcome back. Speaking of gold, we were talking about it right before the break, and today gold prices rose to a two-week high. Word on the street is investors are speculating that central banks around the world will act or print, whatever you want to say. Some believe gold, of course, is a hedge against major inflation. I asked our guest Jim Rogers about the Federal Reserve's latest claims about inflation. Take a listen. Talking about inflation, the president of the Federal Reserve Bank of San Francisco, John Williams, said on Monday that those who have forecast that the Fed's tripling of the monetary base for the past 4 years would cause inflation have been dead wrong. Here's what he said. He said, despite these dire predictions, inflation in the U.S. has been the dog that didn't bark. In a world where the Fed pays interest on bank reserves, traditional theories that tell of a mechanical link between reserves, money supply, and ultimately inflation are no longer valid. What is your take on this? Because it seems that despite all this printing, we haven't seen the inflation you may expect. But what have central banks done? Have they been successful in simply inflating their own balance sheets, but not the broader economy? What do you think?
Ms. Lister, I would suggest Mr. Williams go shopping, or have his go with his butler to go shopping, or his wife, or whoever does shopping in his family. He will see that prices are up a lot. What is he talking about? The man's nuts. Or maybe he should buy some insurance, or education, or entertainment. Prices are up. The government is lying about it. He's part of the government. He has to carry on with the lie. But nearly every country in the world, Ms. Lister, acknowledges that there's inflation, except in the United States. Now, I find it incomprehensible that we can have inflation everywhere in the world except the United States. But the people and everybody who's watching this program, who shops for anything, knows that prices are up. So I suggest Mr. Williams stop putting out government propaganda and go shopping.
Well, you know, it's funny. When my cab fare went up and when the pizza place started charging higher prices downstairs, I thought of you talking about going shopping. And now, you know, you see how much the prices are rising. Don't listen to the government. But one thing that to go along with his government inflation numbers that he said was that maybe when his view of inflation started really impacting the economy, what the Fed would need to do is maybe pay more interest on excess reserves that banks keep at the Fed. What happens in that scenario? I mean, can the Fed afford to do that? Do they go into cash flow negative territory?
What's going to happen is what's happened throughout history. As inflation seeps more into the world economy, interest rates go higher. Interest rates are going higher in other parts of the world, Ms. Lister, I would remind you. Interest rates will go higher. The U.S. government will have to pay higher interest rates, including the Federal Reserve. Does that throw the Federal Reserve into a negative balance, cash flow? I don't know. I'd have to look at their balance sheet. I know they have a lot of junk on their balance sheet without adjustable rates, so I'm sure it will throw the Federal Reserve into more difficult times, too. But, Ms. Lister, I've said to you before, in America, we've had 3 central banks. The first 2 disappeared for a variety of reasons. This one's going to destroy itself. I mean, they keep making such absurd decisions down there that they're going to put themselves out of business eventually, which will be good news for all of us. I mean, the world has difficulties without a central bank, but this central bank, my goodness, it's certainly not good for America or for the world. Well,
and one thing, though, that we have seen is people still running to the U.S. dollar and U.S. treasuries and giving some kind of placating effect on the Fed and the U.S. government and policymakers here in D.C. With the euro being in the situation it is, how long does this prolong the slumber in the U.S., or do you see some kind of a day of reckoning?
Well, I own the U.S. dollar at the moment. I'm not quite sure how much longer I'm going to own it, whether I own it another day or another year. I don't know. I own it because of turmoil in the rest of the world. Unfortunately, I mean, the U.S. dollar is not a safe haven. The U.S. dollar, the U.S., are the largest debtor nation in the history of the world. So it's not a safe haven, but since people don't know what else to do, they go to the dollar. But eventually, we, too, are going to have to pay the piper. There's no question, because we keep making worse. Our situation overall is worse than Europe's situation overall, just that the attention at the moment is on Europe. If you can figure out a way, and I'll have to watch RT TV some more to find out, but I'm looking for a place, I'm looking for a sound currency, and so far, they don't exist.
And in that context, do you see any opportunity for the renminbi if, for example, it became more flexible, or does China's current situation with a more global slowdown make that not at all feasible?
Well, the renminbi is a blocked currency right now. They have been making it more and more open for the past 7 years. and they continue to. I would do it this afternoon if I were China, but I'm not China, and they don't have to listen to me. I would make it open now, and then conceivably someday the renminbi could compete with the U.S. dollar, but that would take a long time. Lauren, even if they made it convertible this afternoon, it takes a long time. These are huge movements in world history and in world economics, so it would take a long time for the renminbi to finally compete. But there's not much else that I can see on the horizon except the renminbi, or if somehow we could have a sound euro, that could compete with the U.S. dollar.
Interesting. So would you say, just looking broadly, that we're in a world right now with kind of perverse things going on, where you have the euro deteriorating and Europe deteriorating, so people are running to the dollar, which really shouldn't be considered a safe haven because look at the U.S. debt. So you have all these perverse things going on. Do you think we're going to see a lot of unintended consequences down the line from these perversities?
I wouldn't call them perverse. I would call them natural. I mean, you know, when Europe makes huge mistakes like that, what do you expect to happen? Do you think everybody wakes up and says, this is wonderful, we're all spending money we don't have? This is the way the world should be. These aren't perverse. This is natural what's happening, and unfortunately politicians keep digging deeper and deeper holes and making the situation worse and worse, and eventually we're all going to have to pay the price. We're going to see more institutions disappear. We're going to see more governments fail. We're going to see some countries fail. You cannot keep building up staggering amounts of debt. It has never worked in history to keep piling debt on debt on debt. Eventually, you have terrible unrest within your economy and then terrible unrest within your society, and eventually it's always led to war. I mean, let's hope it doesn't this time, but it's always happened that way.
There you go. You don't have to be a vice chair at BlackRock quoting an unnamed source in Europe. Jim Rogers says it right here. Jim Rogers, investor and author, with that analysis. All right, let's wrap up with loose change. Dimitri, Shannon, let's not end with the Federal Reserve. Let's keep this going on central banks, because the European Central Bank, well, first of all, they're taking a firm stand when it comes to Greece. Listen to this.
The European Central Bank has told Greece not to waste time trying to renegotiate its international bailout to water down the austerity measures demanded. That advice...
Red flag.
But why is that? Could this be because the ECB is too overworked, its personnel at least, to deal with proposals for renegotiating? Because according to a new ECB staff poll, 80.1% of employees complained of a heavy workload. 77% said they were working longer hours with no extra pay. Nearly 16% of the 700 staff polled said their workload was having a serious effect on their private life and or health. I mean, I guess it's just hard work. You got to put in extra hours manipulating interest rates and trying to pull tinkers in the economy.
These guys are wimps. These guys are wimps. I had an opportunity to intern in Brussels at the ECB. I didn't take it. I didn't take it. But yeah, I was offered. Well, I ended up working in Italy instead. It would have been good intel, good insight, inside perspective. Well, anyway, look.
I don't think they're going to take you back now after all you've said about them.
Well, forget them. I don't want to work for these wimps. I mean, they're complaining about their job, and they're like, ooh, we work a lot of hours. It's so hard.
Yeah, who doesn't?
But that's a joke. They don't work a lot of hours. They don't work hard. You got to be kidding me. They're complaining. If you have the time to complain at a poll, I mean, give me a break. This is a joke. This is a joke. It's typical bureaucrats. Nothing worse than a bank bureaucrat. I mean, nothing is worse than that. I mean, banker is top, but then right above them, it's like the special cream, and it's the institutional bankers that, you know, are central bankers or part of the EBA or whatever.
Yeah. I mean, there are plenty of people that are overworked and feel like they don't get enough time off that are doing so for far more productive reasons
right here.
and less consequential to the economy and the consequences of their actions. Shannon, you want to add anything?
I mean, I'm just going to say it. Obviously, Greeks are sometimes hard to deal with.
Hard Ha ha ha, hilarious.
Okay,
So
let's move on.
funny.
Speaking of manipulating interest rates, the Barclays fallout continues over the $450 million settlement and scandal surrounding the allegations that Barclays traders tried to manipulate the LIBOR, the London Interbank Offered Rate. Listen to this.
Just 24 hours ago, the chairman, Marcus Aegis, announced his resignation. He said the buck stops with him. And 24 hours later, the CEO has said that he would stand down after saying he wasn't prepared to.
So the buck didn't stop with the chairman because the CEO stepped down, the COO resigned. So 3 top executives resigning as a result of this scandal. I want to remind our viewers that about 20 other banks are under investigation involved or related to this, including JP Morgan and Citigroup and HSBC and RBS. So we don't know where that's going to go. My question, though, how come we haven't seen heads roll like this in the U.S. for huge settlements and scandals? If you look back, for example, Dimitri, at the Abacus settlement, Goldman Sachs with the SEC, that was a $550 million settlement. That was a really big settlement. And you didn't see Lloyd Blankfein ever pay for it with any kind of consequences like these top executives
whatever. I mean, you know, what interests me more is the way that these guys were manipulating LIBOR.
They're trying to, because it's the idea is if it's one bank that's put it, because it's a poll that creates this rate. So if it's one bank doing it, in order for that to work, wouldn't there have to be more banks colluding in this?
I don't know. Shannon had an interesting take on the mechanics of that with the traders. Shannon, what was that?
I actually did not have any take on that.
Didn't you have something special to say about the way that they were trading with LIBOR?
I did not.
Maybe you do, Dimitri.
Well, no, Greeks are hard to deal with, so I'll just continue.
Let's play nice, folks. Dimitri?
All right. So LIBOR is basically a poll, from what I understand. All right, it's not like the federal funds rate. I think what's interesting, though, is that the traders at Barclays were, besides the macro picture of credit, there was also the individual banks, in this case of Barclays, where the traders are basically saying to the executives, hey, understate what's going on in the credit markets, understate LIBOR, so that we can get better credit terms, because we need we need this liquidity to keep our trades on.
Mm-hmm. Yeah. Well, and one thing I want to add is that some embarrassing reports evidently were coming out that showed that the Bank of England might have had something to do with Barclays manipulating this rate. So I don't know. Maybe when you do the central bank wrong and you're going to embarrass them, that's when CEOs get pressured to step down.
Right.
I don't know. Just saying. We'll leave it at that. We'll let you decide, because that's all we have time for. Thanks so much for watching, and have a great night. And you can always follow me on Twitter. Until our next show, give us feedback at youtube.com/Capital account, or catch any you missed. Remember, yesterday, if you missed it, we had a totally different perspective on commodities from a different guest. You can also see us in HD on Hulu, hulu.com/Capital-account. No show tomorrow. We're off for the holiday. Enjoy yours if you have it. For everyone else, thanks for watching, and have a great night.